The topic for this video is Module 5, Industry Structure, Chapter 15, The Functioning of Financial Markets, for the CFA Institute Investment Foundations Program. So here we are in Module 5, Industry Structure, and the topic for this video is Chapter 15, The Functioning of the Financial Markets. There are 10 learning outcomes statements, and as you can see, there are 39 questions in the learning ecosystem. The learning outcome statements are A, distinguish between primary and secondary markets; B, explain the role of investment banks in helping issuers raise capital; C, describe primary market transactions, including public offerings, private placements, and rights issues; D, explain the roles of trading venues, including exchanges and alternative trading venues; E, identify characteristics of quote-driven, order-driven, and brokered markets; F, compare long, short, and leveraged positions in terms of risk and potential return; G, describe order instructions and types of orders; H, describe clearing and settlement of trades; I, identify types of transaction costs; and finally J, describe market efficiency in terms of operations, information, and allocation. Learning outcome statement A is distinguish between primary and secondary markets. Secondary markets are the main focus of this chapter because most investors buy and sell securities in the secondary markets. So most of the investment industry is focused on secondary markets. But first, we discuss primary markets, which are markets in which issuers sell their securities to investors. In other words, primary markets are where securities first come available to all investors. Issuers are typically companies and governments selling securities to investors in exchange for cash, and it's a way for the companies and governments to raise money. The main primary market transactions are public offerings, initial public offerings called IPOs, private placements, and rights offerings. So if we just take a minute to look at this graphic here, you can see that in terms of an IPO, that's when new securities are issued. So we're talking about a stock initial public offering. There's a private company. It becomes public, so they issue stock to investors, and the company will receive cash. Okay, assets equals liabilities plus equity. An initial public offering will increase cash to the company that they can use to invest in profitable projects, and it'll increase the equity. Okay, then after those shares have been issued, the investors will be able to trade them to other investors through a stock exchange, for example. And it's important to understand that when the investors are trading those securities, it happens on the secondary market, and the issuer is not receiving any cash or capital in the secondary market. Issuers receive cash in the primary market, and then in exchange for securities, and then when those securities are traded amongst other investors in the secondary market, the issuer is no longer receiving cash. It's just an exchange based on supply and demand, etc., between investors. Learning outcome statement B is explain the role of investment banks in helping issuers raise capital. So we're continuing to look at public offerings. So the issuer makes new shares or shares held by the founders and other early investors available for sale to the public. Before a public offering, the issuer typically provides detailed information about its business and inherent risks, as well as the proposed uses for the money it hopes to raise in the form of a prospectus. The investment bank identifies investors who are willing to buy the securities and helps sell the securities to the public in a process called book building. Okay? So when we're looking here at an underwritten offering first, in an underwritten offering, the investment bank buys the securities from the issuer at a price that is negotiated with the issuer and then resells them to the investors at the offering price. This approach effectively guarantees that the issuer will get the amount of capital it expects. In an initial public offering, IPO, the underwriter also promises to ensure that the secondary market for the securities will be liquid and to provide price support for a limited period of time. Okay? So you can see here in an underwritten offering, the investment bank is taking on risk. They're going to buy the entire offering from the issuer, and then they're going to resell it to investors. Okay? Buy low, sell high. They're going to have some type of markup. And they're also, for a period of time, limited period of time, acting as a dealer. They're going to provide some liquidity. Okay? So that helps the issuer because they know exactly how much they're going to receive. It reduces the risk and it provides some liquidity. Okay? But moving on here to a best efforts offering, this is less risk for an investment bank because the investment bank only acts as a broker of the offered securities and does not assume the risk associated with buying the securities. Over here, acting on an underwritten offering, the investment bank will buy the securities, but then it's their responsibility to sell them. They're taking on risk. There could be an issue that they can't sell it all for the price that they expect, which would be greater than the price that they're buying them at. Okay, but in a best efforts offering, acting only as a broker, they do not assume that risk. If the offering is undersubscribed, the issuer will sell fewer securities and may not be able to raise as much capital as it had planned. A single investment bank may not have the distribution network capital or risk appetite to organize a large offering, so large offerings are often organized by a syndicate, okay? And a syndicate just means that it's a group of several investment banks. Learning Outcome Statement C is describe primary market transactions, including public offerings, private placements, and rights issues. So first we're going to look at public offerings or initial public offerings, which we call IPOs, okay? So a company that sells securities to the public for the first time makes an initial public offering, an IPO, also sometimes called a placing or a placement. Practitioners say that the company is going public. The shares offered consist of new shares issued by the company and may also include shares that the founders and other early investors in the company want to sell. If there is more demand than securities for sale, then the offering is said to be oversubscribed. In the case of oversubscription, the securities are often allocated by the investment bank to preferred clients on a pro rata basis, by which all investors get a set proportion of the shares that they ordered. In the case of undersubscription, not enough buyers for all the securities. There's not enough buyers for all the securities that are for sale. The investment bank will be left with unsold securities, which not only commits capital for longer than expected, but is also risky, especially if that's an underwritten offer. Okay. First-time issuers may accept lower offering prices because they are concerned about the possibility of the issue being undersubscribed. In an IPO, the underwriter usually promises to ensure that the secondary market for the securities will be liquid. If necessary, the underwriter provides price support for a limited period of time, typically about 1 month. During that time, if the price of the securities falls below a certain threshold, the underwriter will buy securities to stop or limit the price fall. Providing price support is costly to the investment banks and is another factor that motivates them to choose a lower offering price so that the securities price in the secondary market rises immediately following the IPO. And that's typically a pattern that you see in many IPOs, is that the stock price rapidly increases the same day or immediately following the issuance. So continuing with public offerings, we're just going to look at some terminology here with regards to seasoned offerings, okay? So the most common offering type for seasoned offerings is an underwritten offering. Pricing is less challenging in a seasoned offering because the issuer securities already trade in the secondary market. So what is a seasoned offering? It means that shares of a company are already trading in the public market. They're going to raise new capital through a new placing of new securities. So it's called a seasoned offering because it's not the initial public offering. This is a subsequent offering, okay? And so the most common type is again through an investment bank, is an underwritten offering, okay, or a best efforts, because the shares are already out there outstanding. They have a very good idea of what the price is in the market, okay. Pricing is less challenging because the issuer's securities already trade, thus it's easier to identify an appropriate price for the offering, and therefore the fees charged for a seasoned offering are lower than for initial public offering because there's less risk. Now, companies sometimes sell new issues of seasoned securities directly to the public over time via what's called shelf registrations. And shelf registrations are when the company provides the same detailed information that it would for a public offering. However, in contrast to a seasoned offering in which all the shares are sold in a single transaction, a shelf registration allows the company to sell the shares directly to investors over a longer period of time. Okay, just going to continue with the topic of IPOs, initial public offerings, but I want to bring the real world into the classroom very quickly. So I just want to show an example from Canada. So here I am looking at the TMX Group Limited website, which is a Canadian financial services company, which is publicly listed, by the way. And the TMX Group operates equities, fixed income, derivatives, and energy market exchanges. The company provides services encompassing listings, trading, clearing, settling and depository facilities, information services, as well as technology services for the international financial community. So the TMX Group is best known for its stock exchanges, the Toronto Stock Exchange, which serves the senior equity markets, and TSX Venture Exchange, which serves the public venture equity market. So the venture exchange is like a junior exchange, okay? So if I go here to research and I click on recent listings, you can scroll down, you can see browse companies and investment products that have recently listed on the Toronto Stock Exchange and the Toronto Venture Exchange, the TSX Venture Exchange. So here, nothing in 2019 yet, we're just in January. But if I look at 2018, I click on all months, and you can see we've already covered in previous chapters what exchange-traded funds are, ETFs. So you can see several ETFs being listed in Canada back in 2018 in July. But if I click on, a company, a corporation, here July 6, 2018, MAV Beauty Brands has got a listing. So you can scroll down. You can see there's an exchange bulletin here, MAV Beauty Brands to MAV, that's the ticker symbol, to trade on the Toronto Stock Exchange. So it gives you some information here. Who's the issuer? MAV Beauty Brands Inc., which is the company. They issued common shares, the symbol MAV, and the issue price per security was $14, okay? The number of securities issued and outstanding, 37.5 million. The number of securities reserved for issuance, 7.2 million. Listing category was industrial, trading currency, Canadian dollars, okay? So you can see that this transaction was an IPO, an initial public offering of shares, the offering. So MAV Beauty Brands would have been a private company, and they've done an IPO to raise capital. So the company would have received capital from this offering, okay? And you can see the temporary market maker is TD Securities. So TD Securities would have been the underwriter, okay? So a little bit of nature of business, disclosure documents, etc. And here it is, the IPO, the initial public offering. The initial public offering, the offering consists of 9 million shares from Treasury and a secondary offering of 8,267,000 shares at a price of $14 per share. Okay, so that just gives you a nice little example of an IPO that was done on the Toronto Stock Exchange just back in July of 2018. And if we just follow up, so we saw that MAV was being issued at $14. I'm just looking at the stock quote. It's on the TSX Exchange, January 13th, 2019. And you can see MAV, the last price traded, was $8.15, and not very much volume, okay? So if we look here at the charting, you can see that if I go on to 1 year, the stock was issued back in July of 2018, and you can see it's come down considerably in price. The last price now at $8.50. So not all IPOs go up in price immediately, but we have seen many examples where stocks are there's the initial public offering offered for the first time, and that stock price goes up considerably. But I just want to show you a case that's not always the case. So Mav Beauty Brands did their IPO. TD Securities underwritten, provided some liquidity. Issue price was supposed to be at $14, and here we are, some months later, and it's trading below $9. Now we're moving on to private placements. In a private placement, companies sell securities directly to a small group of investors, usually with the assistance of an investment bank that helps identify potential investors and set the price of the securities. Investors in private placements are expected to have sufficient knowledge and experience to recognize the risks that they assume, so most countries require less disclosure for private placements than for public offerings. So that's important to understand. If there's less disclosure, there's going to be less cost, okay? Typically, it would be institutional investors that are participating in a private placement. Thus, private placements allow quicker access to capital with less regulatory oversight and the lower cost of regulatory compliance than public offerings. Issuers can raise money in the primary markets at a lower cost when their securities can be traded in liquid secondary markets. Investors value liquidity because they may need to sell their securities quickly to raise cash. So investors will pay less for securities that are difficult or costly to sell, illiquid, than for those that are easy to sell. So more liquid securities is going to be at a premium over illiquid securities. Anyhow, because securities offered in a private placement do not trade in a secondary market like securities offered in a public offering, investors are willing to pay less for the former than for the latter. In other words, investors generally require higher returns for securities issued via private placements than for the same securities issued via public offerings. So again, just to bring the real world into the classroom and show an example of a private placement, I just Google searched private placement in Canada, came up with one, an example from August the 30th, 2018, so it's fairly recent. I've personally never heard of this company before. Anyhow, it's called Resverlogics, and they announced a $26 million private placement. But this shows some pretty good information with regards to what we've been talking about. So Calgary, Alberta, so it looks like it's a Calgary-based company in Canada. And this is a news announcement that Resverlogics, and they're publicly listed on the Toronto Stock Exchange, ticker symbol RVX, but they did a private placement for $26 million. So let's see how that worked. They announced on August 30th that it had closed a private placement of approximately 10.4 million equity units at a price of $2.50 per unit for gross proceeds of approximately 26 million Canadian dollars, which is about 20 million US. And it was based on an agreed discount to the 5-day volume weighted average price of the company's shares between July 30th and August 3rd, 2018. So this is what we said, is that because it's a private placement and these shares are not going to trade in the secondary market, that the price is at a discount to the publicly traded. And so here it's not telling, we could go back and look at the share price. Anyhow, each unit will be comprised of one common share and 1/2 of a common share purchase warrant. And we've looked at warrants in previous chapters as well. Each full warrant will be exercisable at a price of $3 per share for a period of 3 years from the closing of the private placement. So you can see the investors are receiving a share and 1/2 of a common share purchase warrant, okay? And those warrants can be exercisable at $3 per share for 3 years after the closing of the private placement. So if the stock goes up to $4 or $5, those investors are going to exercise their warrants, okay? So this is a way of, again, raising capital for the company, Resverlogics. And the units will be subject to a 4-month holding period, so you can't sell them right away. And then they're telling you the net proceeds of the private placement will be used to fund R&D, research and development activities. Okay, so that's just a quick example that I Google searched and found with regards to a private placement in Canada back on August, which shows the concept that because the securities are offered in a private placement do not trade, the investors are willing to pay less than for the former than for the latter. So now we're moving on to rights offerings. So again, just recall the LOS is described primary market transactions. So we're not looking at the secondary market yet. We're still concerning ourselves with the primary market. And so the company is receiving new capital, and that's done through an IPO or a private placement. And now we're looking at the rights issues. And in a rights offering, a company allows existing shareholders to buy shares at a fixed price called the exercise price in proportion to their holdings. The rights that existing shareholders receive are often known as preemptive rights because existing shareholders have the right of first refusal on any new equity offering. So this is a new equity offering, so that's why it's raising new capital for the company. Without such rights, the issuing company's management could reduce the ownership interests of the existing investors. Because rights do not need to be exercised, they are options. Okay, you have the right but not the obligation to buy the new shares in the new equity. If you don't exercise your right, then your ownership in the company will be diluted. Okay, so the exercise price of the rights is typically set below the current market price of the shares, so that buying shares by exercising rights is immediately profitable. That is, an existing shareholder can pay the exercise price and get the shares that can be immediately sold at a higher market price for a profit. Accordingly, most rights are exercised. Existing shareholders who do not want to exercise their rights will be diluted. That is, again, their proportional ownership will decrease because they will not hold the same number of shares in a company that has more shares outstanding. They won't have the same proportion. By selling their rights to others who exercise them, they can receive some compensation for the decrease in their proportional ownership. So rights offerings, subsequent to the rights being offered, they can also trade in a secondary market. So people that have received rights that don't want to exercise them can sell them to somebody else. So again, I just tried to Google search an example of a rights offering done in Canada recently, and you can see here's a company called Canadian Spirit Resources, Inc. They announced the closing of an equity rights offering. So again, this is Calgary, and this is a company that's listed on the Venture Exchange. So it's a junior company. You can see here TSXV, the ticker symbol would be SPI, and it's pleased to announce that it closed effective December 3rd, 2018. Its previously announced rights offering equity financing. Okay, so you can see this the rights offering offered rights to holders of its common shares at the close of business on the record date of October 26, 2018, on the basis of one right for each common share held. Each 9 1/2 rights entitled the holder to subscribe for one common share of CSRI upon payment of the subscription price of 8 cents per common share prior to the expiry date of November the 30th, 2018. So these rights would no longer be trading. It would be those rights might have traded, but by now they would have been delisted. Anyhow, the rights offering was fully subscribed in this case, resulting in the issuance of 18,683,579 common shares and total gross proceeds to the corporation of $1,494,686 Canadian dollars. Upon completion of the rights offering, the corporation had an aggregate of 196,177,583 common shares issued and outstanding. So that's just a quick example of a recent rights offering in Canada to help complement your understanding of this chapter. Now we're just going to look very quickly at other primary market transactions. So the national governments of financially strong countries generally issue their debt securities in public auctions and may also sell securities to dealers who then resell them to their clients. Smaller and less financially secure national governments often contract with investment banks to help them sell their securities. Learning Outcome Statement D is explain the roles of trading venues, including exchanges and alternative trading venues. So far we have described how primary markets operate. The rest of this chapter now focuses on secondary markets and how they help investors buy and sell securities. In secondary markets, securities trade among investors, and there is thus a need for a trading venue, either physical or electronic, where orders can be placed and trading among investors can occur. So orders are instructions that investors who want to trade give trading service providers such as brokers and dealers. Exchanges are where traders can meet to arrange their trades. Historically, brokers and dealers met on an exchange floor to negotiate trades. However, increasingly, exchanges now arrange trades based on orders that brokers and dealers submit to them electronically. These exchanges essentially act as brokers, blurring the distinction between exchanges and brokers, okay? But the main distinction between exchanges and brokers is their regulatory operations. Most exchanges regulate their members' behavior when trading on the exchange and sometimes also away from the exchange. Brokers generally regulate trading only in their brokerage systems, okay? Many exchanges also regulate the issuers that list on the exchange, generally requiring timely financial reporting and disclosure. Without such information, valuing securities would be very difficult, and in such situations, well-informed participants can profit from less informed participants. So to avoid such losses, less informed participants will withdraw from the market, which is determined not only, it's detrimental not only to the financial services industry, but also to the economy. Okay, that's why there's a lot of, if you're publicly listed, there's a lot of disclosure requirements with regards to your financial statements, okay? So some exchanges prohibit companies from concentrating voting rights in the hands of a few shareholders who do not own a proportionate share of the company's equity. Exchanges derive their regulatory authority from their national or regional governments or through voluntary agreements by their members and their issuers. Exchanges charge fees for their services. They may charge the buyer, the seller, or both parties a transaction fee, which is essentially a commission for facilitating trades. Now we're going to look a little bit at alternative trading venues. Alternative trading venues, not all secondary market trading takes place on an exchange. There are a number of alternative trading venues that are owned and operated by brokers, dealers, exchanges, banks, and private companies. These venues can take many different forms and may be called by many different names. In the United States, such venues are generally referred to as alternative trading systems, whereas in Europe they are commonly called multilateral trading facilities. So again, it's learning the language of the industry. Many alternative trading venues permit only certain traders or types of traders to use their trading systems, and each has their own set of rules. Some alternative trading venues operate electronic, computerized trading systems that are similar to those operated by exchanges. Others operate innovative trading systems that suggest trades to their clients based on information that clients share with them or that they obtain through research into the client's preferences. One type of alternative trading venue is a crossing network, which is an electronic trading system that matches buyers and sellers who are willing to trade at prices obtained from exchanges or other alternative trading venues. Crossing networks are popular with investors who want to trade large blocks of securities. The reason why an investor would want to use a alternative trading venue for large blocks of securities is that if they were to put that order in to an exchange, that order can be seen, and that runs the risk of moving the price of the securities by simply submitting the order. So people can see, oh, there's a big buy order coming in, or there's a big sell order. If you see a big sell order, the price is going to go down. If you see a very large buy order, that's going to help drive the price up. So therefore, some alternative trading venues are known as dark pools because of their lack of transparency. You can't see the size of the order. So dark pools do not display orders from clients to the other market participants, and therefore it won't have an impact. Big orders won't have an impact on the price. Okay, so large institutional investors may transact in dark pools because market prices often move to their disadvantage when other traders know about their large orders. So in terms of comparison of trading venues, an important distinction between exchanges and alternative trading venues is the regulatory authority that exchanges exert over their users of their trading system. Alternative trading venues only control the conduct of subscribers who use their trading systems. So very quickly, bringing the real world into the classroom, here I am, again, another Canadian example. I'm looking at the website for the Ontario Securities Commission, and the page here is Alternative Trading Systems, just to see a little bit of information. So as a marketplace, an alternative trading system, ATS, or alternative trading venue, is regulated under the Securities Act Ontario and National Instrument Marketplace Operation, et cetera, et cetera. Okay, so that's telling you how they are regulated. But the definition of an alternative trading system is a marketplace. It brings together buyers and sellers of securities. It brings together the orders for securities of multiple buyers and sellers, and uses established non-discretionary methods under which the orders interact with each other. Okay, so ATS, alternative trading systems, provide automated trading systems which bring together orders from buyers and sellers. Unlike an exchange, an ATS does not require an issuer to enter an agreement to have its securities traded on the marketplace. They do not provide directly or through one or more subscribers a guarantee of a two-sided market for security on a continuous or reasonably continuous basis. And they do not set requirements governing the conduct of subscribers other than conduct in respect to the trading by those subscribers. Okay, so there's, again, some differences between exchanges and alternative trading systems. And if you scroll down, I'm not going to read the whole thing, but you can see there's some, some review process, some requirements. But nevertheless, I just wanted to scroll down to this section. You can see the ATS's, alternative trading systems that are operating in the province of Ontario and Canada is Bloomberg Tradebook Canada, GX Canada, Instanet, LiquidNet, MatchNow, Omega ATS, TMX Select, and Sigma X. Those are for equity alternative trading systems. In terms of debt, CanDeal, CBID, CBID Institutional, and Market Access. Okay, so just a quick overview of some alternative trading systems in Ontario, Canada. So a quick practice question from the learning ecosystem to check our understanding, and this one is classified at the difficult level. And the question is, to minimize adverse price movements, an investment manager will most likely execute a large order, A, within dark pools, B, on the floor of a stock exchange, or C, by using an electronic order matching system. And the correct answer is A. To minimize adverse price movements, an investment manager will most likely execute a large order within dark pools. Alternative trading systems are trading venues that function as exchanges. Many alternative trading systems are known as dark pools because of a lack of transparency. Orders are not displayed to the market, so they won't influence the price. Okay? Large investment managers like alternative trading systems because market prices often move to their disadvantage when other traders know about their large orders. Most alternative trading systems allow institutional traders to trade directly with each other. Learning outcome statement E is identify characteristics of quote-driven, order-driven, and brokered markets. Okay, so we're carrying on with our discussion with regards to secondary markets and trading in secondary markets. So secondary markets are organized either as call markets or as continuous trading markets. In a call market, participants can arrange trades only when the market is called, which is usually once a day. In contrast, in a continuous trading market, participants can arrange and execute trades anytime the market is open. Most markets, including alternative trading venues or alternative trading systems, are continuous. Buyers can easily find sellers and vice versa in call markets because all traders interested in trading or orders representing their interests are present at the same time and same place. Call markets thus have the potential to be very liquid when they are called, but they are completely illiquid between calls. In contrast, traders can arrange and execute their trades at any time in a continuous trading market, but doing so can be difficult if the buyers and sellers or their orders are not both present at the same time. Okay? So secondary markets organized either as call markets or continuous trading markets. Now moving on to just a brief definition of quote-driven, order-driven, and brokered markets. In a quote-driven market, investors trade with dealers. Dealers provide liquidity in quote-driven markets. For order-driven markets, rules are used to match buyers and sellers, price, and time. Okay? Order-driven markets arrange trades by ranking orders using precedence rules. The rules generally ensure that traders who provide the best prices, display the most size, and arrive early trade first. Continuous order-driven markets price orders using the discriminatory pricing rule. Under this rule, standing limit orders determine trade prices. Okay? And finally, for brokered markets, in a brokered market, brokers find a counterparty for a trade. Brokers help people trade unique instruments or positions for which finding a buyer or seller is difficult. And the example I always tell my students is, think of a real estate broker. They arrange real estate transactions between buyers or sellers. There's no real estate exchange for residential houses, for example. Or think of yacht brokers. There's no yacht exchange, but there are yacht brokers who help. They help find a counterparty for a trade. Someone has a yacht that they want to sell, and the yacht brokers assist in finding a buyer. Okay, so brokered is easy to understand. So what you need to focus in on is really the difference between quote-driven and order-driven markets. So I'm just going to follow up with a bit more information on quote-driven markets and order-driven markets. In quote-driven markets, markets in which investors trade with dealers, also called dealer markets or price-driven markets. So that's an important thing. Quote-driven markets are also called price-driven markets. It's the same thing. These markets take their name from the fact that investors trade with dealers at the prices quoted by the dealers. Almost all bonds and currencies and most spot commodities, which is commodities for immediate delivery, trade in quote-driven markets or price-driven markets. Okay? Quote-driven markets are also referred to as over-the-counter markets, OTC markets. So OTC markets, or quote-driven markets, or price-driven markets all are referring to the same thing. Okay? So over-the-counter markets are securities once literally traded over a counter in the dealer's office. Now most trades in over-the-counter markets are conducted electronically by telephone or sometimes via instant messaging systems even. Moving on to order-driven markets, many shares, futures contracts, and most standard options contracts trade on exchanges and alternative trading systems that use order-driven trading systems. Order-driven markets arrange trades using rules to match buyer orders with sell orders. Orders typically specify the quantity the traders want to buy or sell. The order may also contain price specifications, such as the maximum price that the trader will pay when buying, or the minimum price that the trader will accept when selling. And order-driven markets must have settlement systems to ensure that buyers and sellers settle their security trades and perform on their contract trades. Just very quickly again on the brokered markets, it's markets where brokers arrange trades among their clients. Brokers organize markets for their assets that are unique and thus interesting to only a limited number of people or institutions. Generally, these assets are infrequently traded and expensive to carry in inventory. Examples of such assets include very large blocks of shares and real estate, okay? The example that I gave before. Because dealers generally are unable or unwilling to hold these assets in their inventories, they will not make markets in them. That is, they will not stand ready to buy or sell these assets if nobody else does. So organizing order-driven markets for these assets does not make sense because too few traders will submit orders to them. So a quick practice question from the learning ecosystem. This was classified at the difficult level. Stock exchanges most likely use trading systems that are A, price-driven, B, order-driven, or C, quote-driven. So the correct answer is B. Stock exchanges most likely use trading systems that are order-driven. So I cut and paste from the previous slide. Order-driven markets, trades are arranged using the rules to match buy and sell orders. Exchanges and alternative trading systems are examples of order-driven markets. Quote-driven markets, investors trade with dealers at prices quoted by dealers. And again, quote-driven markets, price-driven markets, and over-the-counter markets are all referring to the same thing. Finally, in brokered markets, brokers arrange trades amongst their clients. Assets are infrequently traded and expensive to carry in inventory. So many shares trades on exchanges that use order-driven trading systems. Order-driven markets arrange trades by using rules. And again, just remember that price-driven and quote-driven markets are the same thing. They are also called over-the-counter markets. They are markets in which investors trade with dealers at the prices quoted by the dealers. Almost all bond and currencies and most commodities for immediate delivery trade in price-driven, quote-driven markets. Here's another quick practice question, but this is not from the CFA Institute Investment Foundations program. It's actually out of the CFA Level 1, but this is why, I just want to show this for a couple of reasons. Number one, it's a little bit tricky because they're using the least likely versus the most likely, and we don't see that a lot in the CFA Foundations practice questions, but you may see that on the exam, so this is a good chance. And again, I just wanted to reinforce the fact that a lot that you're learning at the CFA Institute Investment Foundations program is, it's equivalent to maybe, they advertise it as equivalent to 10% of the CFA program. So there's a lot of overlap. You're getting your first introduction to the content and curriculum. Anyhow, this is the question from the CFA Level 1. A call market is least likely characterized as a market that A, with bid-ask prices posted by dealers, B, where buy-sell orders are cleared at a single equilibrium price, or C, with participation by a small number of active investors, traders. So the correct answer here, a call market is least likely characterized as a market with bid-ask prices posted by dealers. We can see here in a call market, traders and investors indicate their bids and asks for stocks, and they are not posted by dealers. Also, a call market is not a dealer or quote-driven market, OTC market, or price-driven market, meaning all the same thing. Anyhow, what I wanted to show you is that if you come across a least likely type question, you're looking for the false. So a call market is characterized where buy and sell orders are cleared at a single equilibrium price. That's true. A call market is characterized as a market with participation by a small number of active traders and investors. That's true because they come together at one time, so it's a smaller number of active traders and investors. A call market is a market with bid and ask prices posted by dealers. No, that's the false. So you can see here when you get confronted with a question that's in the least likely, turn it into a true or false, and the false is the least likely, okay? And again, my exam tip is that I'll sometimes write it down. I don't do everything in my head. I'll look at it very closely, and I'll turn it into true or false. True, true, false, least likely, looking for the false, okay? So a little bit of an exam tip using a CFA Level 1 question, which is posted in the least likely. Just be prepared to maybe see that on the exam. Learning outcome statement F is compare long, short, and leverage positions in terms of risk and potential return, okay? So investors are said to have long positions when they own assets or securities. Examples of long positions include ownership of stocks, bonds, currencies, commodities, or real assets. Long positions increase in value when the prices rise. So as I have often said, buy low, sell high when you're in a long position. Just think of it that way, okay? So your gains occur when the prices rise, all right? So the potential gains in a long position are generally unlimited, but the potential losses on long positions are limited to no more than 100%, a complete loss for long positions with no associated liabilities or debt. So just think, I buy a stock for $100, okay? What's my potential upside? Well, in theory, it's unlimited. You know, the stock price can't go to infinity, but there's no cap to the upside, okay? But in terms of the downside, the stock could go down to zero and be worthless, and I've lost my entire investment, 100%, a complete loss, okay? Now, in contrast to that, when we're looking at short positions, to take short positions, investors must sell assets or securities that they do not own, a process that involves borrowing the assets or securities, selling them, and then repurchasing them later to return to their owner. So I've mentioned this before. We want to sell high and buy low. Okay, so that's the way to look at a short position. Sell high and buy low. Gains occur when the prices fall. Okay, so getting back to the chapter on derivatives a little bit, a call option gives you the right but not the obligation to buy a stock. And so you're going to do that when you're bullish. You're going to make money if the price on the stock rises. But if we look at a put option, that gives you the right to sell. We're going to profit if the price of the stock falls. Sell high, buy low for a short position, buy low, sell high for a long position. Okay, not too difficult to understand. But what you need to understand is the difference in terms of potential gain and potential loss with regards to a short position. It's very different. Remember, if I'm buying a security, my maximum risk, it can fall to zero, and I'll lose my initial investment. But let's say I sell short a stock that I don't own at $100 and I receive that $100. Okay, the maximum profit would be the $100. If I sell at 100 and I buy at zero, I've made $100. Or let's just say I bought it at $1, the stock went down to $1, I made $99. Anyhow, you can see by selling high and buying low, there's a limit to my maximum profit. But if I look at my maximum risk, again, I've sold the stock at 100, I need to buy it back at a later date. You can see the same concept. If that price rises and rises, to infinity, then I have an unlimited risk, okay? Because I've sold at 100, but I need to buy it back. The stock price could rise. I've got unlimited risk, but I have limited profit to the amount that I've originally invested. That's a lot different than buying a stock where my maximum loss is the amount that I've initially invested, okay? So the unlimited potential losses make short positions potentially very risky. Although security lenders generally believe that they still own the securities that they lend, this is not the case during the period of the loan. Instead, security lenders own promises made by the short sellers to return the securities recorded in security lending agreements that specify the short sellers will pay the long sellers all dividends or interest that they otherwise would have received had they not loaned the securities, and they protect the lenders in the event of a stock split. These payments are called payments in lieu of dividends or interest. Security lending is subject to the risk that one of the parties to the contract will fail to honor the obligation, a risk called counterparty risk. To limit counterparty risk, security lenders require that short sellers leave the proceeds of the short sell on deposit with them as collateral for the loan. Collateral refers to assets that a borrower pledges to the lender. Short sellers must provide additional collateral to secure the loan following an increase in the price of securities. Securities lenders must return some of the collateral following a decrease in the price of securities. So now we're moving on to leverage positions. Hopefully you've got a good understanding now of long and short positions. Now we're moving on to leverage positions. And in many markets, investors can buy securities on margin, that is, by borrowing some of the purchase price. When investors borrow to buy securities, they are said to leverage or lever their positions. A highly leveraged or levered position is one in which the amount of debt is large relative to the equity that supports it, okay? So buying securities on margin increases the potential gains or losses for a given amount of equity in a position because the buyer can buy more securities using borrowed money. Investors usually borrow the money from their brokers. It's a margin loan. The maximum amount an investor can borrow is often set by the government, the trading venue, or another trading services provider such as a clearinghouse. The loan does not have a set repayment schedule and must be repaid on demand, and the borrower must pay interest on the borrowed money. Okay, so here I'm going to run through a quick example. This is my own example. It's not in the textbook, but again, I'm starting with the accounting equation: assets equals liabilities plus equity. And so we're going to look at an example here of a stock that costs $100. Okay, and if I borrow $60, then the margin, my equity, is $40. Okay, asset equals liabilities plus equity. My equity is the $40, and that's what we call the margin. That's the important thing to understand. Now, if the stock should go up 10%, the stock would be at $110. Now, let's say that the liability has not changed. Okay, so to make the accounting equation balance, assets equals liabilities plus equity, what's happened here? The stock price has gone up, and my equity has gone up, okay, from $40 to $50. So the stock return, ending minus beginning divided by beginning, is how we calculate holding period return. You can see that equals 10%. But my investor return is ending minus beginning divided by beginning. It's the $50 equity minus 40 divided by 40. I've actually got a 25% return, okay? So there's a couple of things here on the left-hand side. The position value divided by the trader's equity gives you the leverage ratio. So the position value, $100, divided by the trader's equity or margin, because we call that margin, so just be careful with the language, $100 divided by 40 equals a 2.5% leverage ratio, and that's in terms of times, okay? Then, if I want to calculate the trader's return, I use the asset or the securities return times that leverage ratio gives me the trader's return. So again, using this example, the asset or securities return was 10%, the leverage ratio was 2.5, 10% times 2.5, and I get my 25% investor return, okay? So hopefully, I know if you read through the text for the first time, talking about margin and leverage ratio and trader's return, it can be a little bit confusing, but if you just work through this numerical example, assets equals liabilities plus equity, 100 equals 60 plus 40, 40 is my initial margin, stock goes up 10%, so my equity is now $50, because assets equals liabilities plus equity. The liability hasn't changed, the loan hasn't changed. Stock return 10%, my investor return 25%. Leverage ratio, the position value divided by the equity, that's a leverage ratio in terms of times, it's a multiple. And then to get my trader's return, the security return times that leverage ratio, okay? Not too bad, not too difficult. Learning outcome statement G is describe order instructions and types of orders, okay? So when investors want to trade a security, they issue an order that will be directed to a chosen trading venue. All orders specify what security to trade, whether to buy or sell, and how much should be bought and sold. In addition, most orders have other instructions attached to them, including order execution, exposure, and time and force instructions. In quote-driven markets, the prices at which dealers are willing to buy from the investors or other dealers are called bid prices, and the prices at which they are willing to sell are called ask prices or offer prices. The ask prices are invariably higher than the bid prices. Dealers must also indicate the quantities that they will trade at their bid and ask prices. These quantities are called bid sizes for bids and ask sizes for offers. Dealers are said to quote a market when they expose their bids and offers. They often quote both bid and ask prices, in which cases they quote a two-sided market. The highest bid in the market is the best bid, and the lowest ask in the market is the best ask. The difference between the best bid and the best offer is the market bid-ask spread. The market bid-ask spread generally is smaller than every dealer's bid-ask spread. It can never be more because dealers often quote better prices on one side of the market than the other. So accordingly, the bids and asks that make up the best bid and ask often come from different dealers. Okay, this slide is actually from CFA Level 1, but I think it's going to help your understanding here at the Investment Foundations level. Okay, it's a little bit of a graphic, and it's showing some order prices. On the left-hand side, you have here the bids. Those are prices that investors want to buy the security at. And here you've got the asks. these are the prices that investors want to sell the security at. Okay, so as we just saw on the previous slide, if we're looking here, those that want to buy, the highest price that an investor is willing to buy at is 26, well, let's call it dollars, $26, and that's called the best bid, and it's at the market. Okay, if we look on the sell side, you can see here some investors want to sell at 33, 32, 31, etc. But the lowest price that the investor wants to sell at is at 28, and that's the best offer, and that would be the market. That's the market bid and the market ask. Okay, and then you can see there's a difference between 26 and 28. That's the market bid-ask spread. The space between the current best bid and offer is inside the market. If a new limit order arrives here, it makes a new market. So let's say there was an order to buy at 27, then you would have a new market. Okay, so a little bit, this is a nice to know, not need to know, but from CFA level 1, if you look at these orders down here, they're behind the market, and if it's way back, they're far from the market. Okay, so just a little graphic here to help you with your understanding of bid and ask and offer prices. So again, learning outcome statement G, describe order instructions and types of orders. So here first we'll look at a market order. A market order is for immediate execution at the best available price. Different than a market order would be a limit order. An example of a limit order is to buy at a limit price or lower. So we could see from the previous slide, an example of a limit order would be to buy at $26 or lower. A limit order to sell would be to sell at a limit price or higher. So again, from the previous example, it would be sell at $28 or higher. Okay. What is a stop loss order? A stop loss order is to sell the stock if it goes down to the stop price. So let's say that the stock has been trading at $27 and there's a stop loss order at $25. What it means is when one board lot trades at $25, then that stop loss order becomes a market order. So that's an important thing to understand. A trade at the stop price activates a market order. So even though you've put in a stop loss at 25, doesn't necessarily guarantee you'll get $25 per share. Once one board lot trades at $25, you become a market order, so it'd be priced then, your order will be filled at the market price. Okay, so stop loss is used when people want to limit their downside. Okay, what is a stop buy order? A stop buy order is to buy the stock if the stock goes up to a stop price, and a trade at the stop price activates a market order. And so someone who has done short selling to limit their potential losses might also put in a stop buy order, so that if the stock goes up to a certain price, their order will become a buy order at the market, and they'll have limited their loss on their short sell. Okay, you can also have a stop limit order, and that stop would trigger a limit order. But it's important to understand a stop loss or stop buy. A trade at the stop price activates a market order. That's the key thing. This slide is looking at order exposure instructions. Exposure instructions indicate whether, how, and sometimes, or to whom an order should be seen. So hidden orders are only seen by the brokers or trading venues that receive them and cannot be seen by other traders until the orders can be filled. Note that there is nothing wrong or unethical about hiding an order. Traders with large orders use hidden orders when they are afraid that other investors might trade against them if they knew that a large order was in the market. Sellers generally do not want to be the first to trade with large buyers because large buyers often push prices up. Large buyers also fear that other buyers will be able to trade before them by buying first to profit from any increase in price necessary to fill their large orders. This increase in the cost of filling large orders by taking buying opportunities away from the large traders. Okay, so large sellers likewise fear that buyers will shy away from their exposed orders and that other sellers will front run their orders. So now we're moving on to order time and force instructions. So time and force instructions indicate when an order can be filled. The most common time and force instructions are: number 1, immediate or cancel orders, which can be executed only on immediate receipt by the broker or trading venue. Day orders, which can be executed only on the day they are submitted and canceled at the end of the day. Good until cancel orders can be executed until they're canceled. Sometimes brokers or trading venues may set a maximum number of days that the order is automatically canceled. So I might put in I'd like to buy at $25, good until canceled. Well, it's a maximum of 30 days, so that order would be there for 30 days. If it wasn't executed, then it's going to be canceled. Learning Outcome Statement H is describe clearing and settlement of trades. Okay, so we're looking at the clearing and settlement cycles now. Clearing refers to all activities that occur from the arrangement of the trade up until settlement, which is the final exchange of cash for securities. The most important clearing activity is confirmation, which is performed by clearing houses. Before a trade can be settled, the buyer and seller must confirm that they traded and the exact terms of the trade. Confirmation generally takes place on the day of the trade and is necessary only for manually arranged trades. For electronic trades, confirmation is done automatically. To ensure that the members settle their trades, clearing houses require that the members have adequate capital and post margins. Following confirmation, settlement may occur in real time, instantaneously, or may take up to 3 trading days. So we see for a lot of stock markets, settlement is trade date plus 3. For example, in most countries, stocks and bonds settle 3 days after negotiating a trade. The seller must deliver the security to the clearing agent, and the buyer must deliver cash. The settlement agent then makes the exchange in a process called delivery versus payment. Many markets have reduced the length of their settlement cycles to reduce what is often referred to as settlement risk, a form of counterparty risk in which one of the parties fails to honor their obligation between the time a trade is negotiated and the time the trade is settled, for instance, as a result of bankruptcy. Also, the shorter the settlement period, the fewer extreme price changes will occur before final settlement. So once a trade is settled, the settlement agent reports the trade to the issuing company's transfer agent, usually a bank or trust company, which maintains a registry of who owns the company's securities. So the transfer agent, usually a bank or trust company, maintains a registry of who owns the company's securities. That's important for payment of dividends. That's important for proxy voting on common shares, etc. So companies need to maintain databases about their security holders so they know who's entitled to any interest and dividend payments, who can vote in corporate elections, and to whom various corporate communications should be sent. So a quick practice question from the learning ecosystem at the expert level. I must say this one is a little bit tricky. Which activity is a clearing activity? A, exchanging cash for securities. B, confirming the terms of the trade. Or C, reporting the trade to the company's transfer agent. Okay, I like this question because it's an example CFA Institute quite often, especially CFA Level 1, you've got three answers. Actually, A is right, but B is more right, okay? And that's one of the issues with regards to the CFA Institute. You have to choose the solution that is more right, okay? And that's what makes these questions very difficult, because it says which activity is a clearing activity? And A is exchanging cash for securities. Well, here, right from the text, clearing refers to all activities that occur from the arrangement of the trade up until settlement, which is the final exchange of cash for securities. So exchanging cash for securities is a clearing activity. It's right here from the graph that we saw, okay? But B is correct because the most important clearing activity is confirming the terms of the trade. So that's why I put that into that slide, okay? So it says A and C are incorrect because exchanging cash for securities and reporting the trade to the company's transfer agent are activities that occur after clearing activities and are settlement activities. So it's clearing and settlement, okay? So in terms of clearing, the confirmation is the most important clearing activity, okay? A little bit confusing. That's a tough one. If you look at the definition up here and you look at the graph, you would say to yourself, well, A is also right, but in fact, B is more right. So welcome to the world of CFA Institute and very tricky expert questions. Okay, this slide is just showing a graphic with regards to a trade from order to settlement or closure. So an order is placed. So the question is it a market order? Yes or no? If it is a market order, then you know it's going to be executed at the best available market prices, and the order is going to be settled. If it's not a market order, then it's some type of, let's say, a limit order, a buy limit order. If the order executed, yes, then it's going to settle. If it's not executed yet, so let's say I've got a buy order in at $26, but the best ask is $28, and I have this as it's a day order, and the stock never trades at $26 for the entire day, so the order is not executed. Is it going to remain open? No, the order is going to be closed. Well, at the end of the day, the investor may call the broker and say, okay, the order wasn't filled. I'd like to make that a good till canceled up to the maximum. Maybe the rules for that is 30 days, so the order will go in to buy at $26. Maybe it's for 1,000 shares, for example. I'd like to place a buy order for 1,000 shares at $26, good till canceled. In that case, it's 30 days because that's the limit. It's going to remain open until it's filled. If it's filled, it's going to be settled. If it's not filled, it's going to remain open, okay? And if the 30 days come up and it's never traded at $26, the price has gone up, then the order is going to close. So that's just a simple graphic with regards to a trade from order to settlement and the difference between a market order or some type of limit order. So a quick practice question to check our understanding out of the learning ecosystem classified at the expert level. And the question is, a registry of who owns a company's securities is usually maintained by A, an exchange, B, a custodian, or C, a transfer agent. Okay, the correct answer is C. A registry of who owns a company's securities is usually maintained by a transfer agent. A transfer agent, which is normally a bank or trust company, maintains the registry of who owns the company's securities. That's important because they have to know whom to distribute interest or dividends with regards to who's entitled voting in elections, etc. Now, the reason why I like this question is because it's just looking for a definition. And I said that I've pointed out many times the importance of the glossary, which is a PDF document that can be found on the website under the curriculum materials. And if you look in the glossary, they've got the definition for the custodians. Custodians, typically banks and brokerage firms that hold money and securities for safekeeping on behalf of their clients. But the transfer agent, again, it's typically a bank or a trust company that maintains the registry of who owns the company's securities. Okay, so it may be different. So the custodian holds the money and securities for safekeeping on behalf of the clients, but the transfer agent maintains the registry. And again, going back to one of our lessons, we saw the Ponzi scheme with Bernie Madoff, and one of the issues that I said is that statements to the investors were coming on Bernie Madoff's own letterhead, and the clients didn't ask about who's the custodian. Where is my money and securities being held for safekeeping? Well, they weren't being held by a custodian for safekeeping. The money was being used by Bernie Madoff for his own personal reasons. That was a Ponzi scheme. So anytime you're dealing, not with a major bank, some type of independent investment advisor, etc., you want to definitely know who is the custodian, who is holding my money and securities for safekeeping. Very important question to ask. Learning outcome statement I is identify types of transaction costs. So you can see here transaction costs, they've got two categories. On the left, explicit trading costs. On the right, implicit trading costs. And explicit trading costs plus implicit trading costs equals our total trading costs. So what makes up explicit trading costs? That's the brokerage commissions and fees to trading venues and financial transaction taxes. The implicit trading costs are made up of bid-ask spreads, price impact, and opportunity costs, okay? So again, looking at explicit trading costs, the direct costs, those are the direct costs associated with trading. Brokerage commissions are the largest explicit trading cost. The commissions are usually a fixed percentage of the principal value of the transaction or a fixed price per share, bond, or contract. The commissions compensate brokers for the resources they use to fill orders. Other costs include fees paid to trading venues and financial transaction taxes, such as the stamp duty in the United Kingdom, Singapore, and Hong Kong. When we look at implicit trading costs with regards to the bid-ask spreads, that's the compensation dealers expect for taking the risk of buying and selling securities. Okay, price impact. Price concessions offered by traders who want to trade quickly. They tend to purchase at higher prices than the prices at which they sell to encourage other traders to trade with them. For large institutional investors, the price impact of trading large orders generally is the largest component of the transaction costs. Okay, so that's an important thing to understand. Brokerage commissions are the largest in terms of explicit trading costs, but price impact for large institutions, the price impact of trading large orders is generally the biggest component of the transaction costs. Okay, moving on to opportunity costs. Opportunity costs, that's the cost of not trading. Traders who are willing to wait until other traders want to trade with them generally incur lower transaction costs on their trades. In particular, by using limit orders instead of market orders, they can buy at the bid price or sell at the ask price. But these traders risk that they will not trade when the market is moving away from their orders. So traders usually choose order submission strategies that minimize transaction costs. So a quick practice question from the learning ecosystem at the expert level. And you can see this is not too difficult because we've just seen the slide with this information. But if it's some months later after you've read it, you may not be able to recall exactly. Anyhow, the question is, for large institutions, the largest component of their transaction costs is generally considered to be A, commissions, B, market impact, or C, bid-ask spreads. So the correct answer is B. Recall, for large institutions, the largest component of their transaction costs is considered B, the market impact. For large trades, impatient buyers generally must raise prices to encourage other traders to sell to them. Likewise, large impatient sellers must lower prices to encourage other traders to purchase from them. These price concessions often occur over time as large buyers push prices up and large sellers push prices down in multiple transactions. For large institutions, the price impact of trading large orders generally is the largest component of their transaction costs. So just remember, total trading costs are made up of explicit trading costs, brokerage commissions, fees paid. Brokerage commissions make up the largest component of explicit trading costs, but this one it's not asking explicit or implicit, it's just saying for large institutions, the largest component of the transaction costs is generally caused by the market impact. And you can see here, I just want to make that point as well, market impact is also referring to the price impact, because it says here, for large institutions, the price impact of trading large, so it's the price impact, they're also calling it the market impact, which again brings up a CFA Institute issue of, you've got a graphic in the text, implicit trading costs, bid-ask spreads, price impact, opportunity costs, but here they're referring to it as market impact, okay? Market impact is the price impact. So again, very careful. You need to be really laser-like with your reading the questions and very much up to speed with all the terminology, okay? And sometimes the cases where different words are meaning the exact same thing. Perfect example of that in this question. And learning outcome statement J, which is the last learning outcome statement for this chapter, is describe market efficiency in terms of operations, information, and allocation, okay? So operationally efficient markets have low transaction costs and small bid-ask spreads and can absorb large orders without substantial price effect. So those are three things that you have to understand about operational efficiency: low transaction costs, small bid-ask spreads, and absorb large trades with little price impact. Those are the characteristics, okay? The benefits of operationally efficient markets are significant. For example, investors who need to move money to the future can easily connect with entrepreneurs who need money now to develop new products and services. Most importantly, these transactions can take place among strangers so that the benefits from trading can be derived from a large number of potential matches. Moving on now to informational efficiency. Informationally efficient prices reflect all available information about fundamental values. They are crucial to an economy's welfare because informationally efficient prices help ensure that the resources available to the economy, such as labor, capital, materials, and ideas, are used wisely. So I'm not going to end the video with a practice question. I just baked one in here from the learning ecosystem. This was at the difficult level. I just want to show an example of a question with regards to efficient financial markets, okay, and describing efficiency in terms of operation, information, allocation. And the question in the learning ecosystem is how closely prices reflect fundamental value as a function of A, operational efficiency, B, allocational efficiency, or C, informational efficiency. And the correct answer is C, because informational efficiency says prices reflect all available information about fundamental value. So you can see fundamental value in the question. It's referring to informational efficiency. That's rated at difficult, but I don't think it's too tough if you've made some good flashcards and are up to speed on the vocabulary, okay? Finally, allocationally efficient economies are economies that put resources to use where they are most valuable. Economies that misallocate the resources tend to waste resources and consequently are often relatively poor, okay? So that's the last slide for this chapter and this topic. And that is the conclusion for this video regarding Module 5, Industry Structure, Chapter 15, The Functioning of Financial Markets, for the CFA Institute Investment Foundations Program. Thank you.